Hello, hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Today we will talk about the Bitcoin price chart. We'll discuss equities and the big week ahead for them. We'll also spend some time discussing the Federal Reserve and what we believe they'll do next week at the FOMC meeting. All of that is coming up, so don't go anywhere. If you enjoy this content, make sure to give my video a thumbs up and subscribe to the channel. I greatly appreciate all of your support, almost to 13,000 subscribers. Now, let's get down to business. So I'm sitting here looking at this weekly chart and we've got 4 pretty ugly candles in a row. This last one was a pretty gruesome inverted hammer. And I had to go back quite a ways in history to find another time where we had 4 red candles in a row on the weekly chart. And it was all the way back here in June of 2020. There were a couple of other instances in late 2019, but you can see it's been a long time since that occurred. So it's a pretty uncommon occurrence for Bitcoin to have 4 red weekly candles in a row. But from a structural support perspective, it hasn't completely cratered. This is really ugly. No doubt, friends, this is not an attractive weekly chart, but we haven't completely cratered yet. And we're actually, we found support right at the first weekly close. Now, I don't know if that's going to hold up, if that's going to mean much moving forward, but if we're looking for a glimmer of optimism here, if we're trying to dissect what's going on structurally for price, this is a higher low. It's a higher low above the first weekly close at the beginning of 2021. So we have not completely broken down in this level yet. And if I go down to my daily chart, we're right in the middle of this key resistance where we've been, for a lot of this time, we've been consolidating, spent quite a bit of time in this specific little box range here. And we're right back in it right now. And in fact, looking to try to turn it into some kind of support. I mean, just absolutely clinging for its life here. And the last time we talked, just a few days ago, I expressed that I thought maybe where we would run out of steam would be somewhere up here around 43.3, 43.500, and that was based on a rolling 30-day median of price. Well, I was a little wrong about that, and in fact, at the time that we were talking, this candle right here was filled all the way up to around 43,000 on the nose, right up to this level, and that ended up being basically the high. It was about 43,000. So I missed it by a couple $100 and price rolled back over because we talked about how at this moment during this breakout, Twitter sentiment immediately flipped bullish. And I said in my last video to you guys that it's always funny to me how quickly sentiment can flip after a long period of consolidation. And while others may see that as bullish, I see a lot of fragility in that, in the quickness that sentiment can be so eager to jump on any sign of positivity. To me, it signals that the market is beat down and it's looking for glimmers of hope. But alas, here we are. We did pull back generally from the spot we would, and now we're trying to gather some support down here. Now, in the short term, I honestly feel that Bitcoin is kind of along for the ride with what's going on with equities. This is a big week for equities that started on Monday because a ton of massive names are reporting earnings this week, Q1 2022 earnings. Now, many of the biggest names are reporting this week, including Amazon, Google, Microsoft, and Facebook. And what I think we may be in store for, if big tech can find a way not to overly disappoint. Now, I'll be the first to admit, talking about earnings and trying to look for alpha around earnings is not an area of my focus. But I do know that many of these big tech names lowered their guidance for Q1 in anticipation of tougher times. And I think that there's room for them to maybe not disappoint on earnings. Maybe they don't smash, but if they can find a way not to disappoint on a big critical week for markets, I think there's a chance that we could see some upside in the short term on the way into next week's FOMC meeting, where the Federal Reserve, in my estimation, will raise the target rate 50 basis points, which is a number they've been priming the market for now for many weeks. And if those things play out as I have outlined them, I think the market could find some mild upside, or at least maintain itself and not completely crater. We are entering a period of tightening. There's slower growth expectations. Earnings are still positive, but likely not to be blowing people's hair back. And the Federal Reserve is committed to this schedule of tightening. I don't think that they'll be able to keep it up for too long. This game of chicken between consumers consumer inflation and exorbitant debt costs while trying to raise the cost of capital. This game has to end at some point, but I think that they can stretch it a little bit longer. And in that time, the markets may not completely collapse. They may just kind of slow bleed to the side. And in that environment, it's possible for Bitcoin to find itself continually setting these higher lows in a very painful fashion. We've already experienced over 3 months of this, and it's conceivable we could continue doing this into the summer. And part of what makes this a big week for equities, in addition to the earnings that I mentioned, is that they are recovering from a brutal close at the end of last week. So Thursday and Friday, with Jerome Powell all but confirming a 50 basis point hike at the beginning of May, it looked like markets finally were coming to terms with the reality that the Fed is committed to this plan of tightening. And so in a way, they started to surrender at the end of last week. I saw on Bloomberg there were massive outflows to a lot of the major ETFs, and it came at the same time that the Dow and the S&P were battling with their 200-day moving averages. Both of them rejected hard. And over the weekend, I heard more than a number of people talking about how Monday would bring a market-wide circuit breaker. Now, if you've never experienced one of those, they're pretty freaky. I was actively day trading in March of 2020 when we experienced 2 market-wide circuit breakers in the same week. A market-wide circuit breaker is when all trading is halted market-wide on all assets. The tickers stop, you can't do anything. And they happen when the indexes fall by a certain percentage in a given day. The trigger in this case was 7% on the S&P. Now, both of the circuit breakers that I'm talking about in March of 2020, they came on March 9th and March 12th. They happened after multi-percentage gap downs on the S&P. The S&P gapped down more than 3% on 2 different days in the same week, on a Monday and a Thursday. And in both of those instances, the entire market was halted. I don't remember for how long it was. I think one of them was for about 45 minutes. And those are extremely bearish conditions. They're done as a preventative measure to keep algos and panic from selling the market into the ground. And when I saw people talking about how they thought Monday would be a day like that, it made me feel like that was a ripe opportunity for positive price action. A market-wide circuit breaker is exceedingly rare. These 2 instances here in March of 2020 are the only 2 times that have happened in my time as a trader. The only 2 times. And they were both more than 2 years ago now. So when I hear people talking about how Monday is going to be a Black Monday, how it's going to be one of the worst stock market days in years, well, usually you don't get to predict things like that. Usually the worst stock market day in years happens because of news that no one was prepared for, that hadn't been priced in yet. And that's kind of what we saw on Thursday and Friday here. We saw the market ultimately realizing that no matter what's going on with the debt, no matter how implausible their plan may seem, for the time being at least, Jerome Powell and the Federal Reserve are committed to raising the federal funds rate. They are committed to tightening, and as a result, the market deleveraged. Now today, on Monday, we did see some positive price action. We had the Dow Jones gap down, and then by lunchtime, it had reclaimed the gap. And the S&P did it in the final hours. The NASDAQ had no trouble at all with its gap down. But this kind of strong price action, after all the lockdowns we hear about in China, all the terrible news coming out of there, the implications that that has for the supply chain and possible additional inflation, those concerns on top of the statements that Jerome Powell delivered last week that rattled the markets down on Thursday and Friday that we saw really set today up to be kind of a doozy, to be very choppy and uncertain. And in the opening few minutes, it was. Price action was really ugly when we first came out of the gates. But by lunchtime, things had smoothed out. We had finally kind of put in the lows right before lunchtime on the Dow and the S&P, and we started climbing back up through the afternoon. And I think, as we discussed just a few minutes ago, that if these big tech names this week can manage not to disappoint, just don't upset the apple cart here on this rocky road. All other factors are essentially known to the market at this point, and if we can continue to march forward here, I think short term we might see some constructive action. There's at least a chance for it. Who knows? We may get blown out one day and I'll wake up and Bitcoin will be down below 36,000. That's certainly possible, but I'm trying to lay out a positive case here because we've certainly spent plenty of time examining the bearish case. And I think at this point, it's well made and well understood. So let's also consider the bullish factors, and those are the things that I could maybe see unfolding for the market. And on the derivative side, since last night, part of this rise up from 38,000 up to over 40K was aided in part by a series of short squeezes, displayed here via the Binance Perpetual Future based with Tether. So up at the top here, we've got the price chart. In the middle is open interest for this instrument. And at the bottom, we've got liquidations. So the black bars are short liquidations. Those are the bears, and the red bars are the long liquidations. Now, what we've seen basically since this little wick here, which came in last night, my time here in the US, price has been climbing up and we've been getting these little squeezes up. And they haven't always manifested in continued pumps, but we've been getting these little squeezes. And every time we get these squeezes, some of the OI gets taken out. See this? See these chunks of OI getting bled out every time we have one of these moves. And every one of these moves has been a short squeeze of a varying degree. Some of them have been getting more aggressive over time. Now, I think maybe they're starting to slow down a bit here, but every time this happens, price gets pushed up, these positions get closed out, and they're registered as a liquidation. These are bears getting squashed. And over this period of time here, from last night up until the time of recording here, this is about 5,500 Bitcoin being taken out on Binance Perp alone, which is about $215 million worth of open interest. Squeeze those bears, baby. I love to see that. Now, this isn't a powerful short squeeze. It's just a series of smaller ones on a very low time frame. You can see I'm just looking at a 5-minute chart, but I wanted to show you what it looks like so that when you see me posting and tweeting about open interest, or when we talk about it in a future video, you'll identify these little squeezes here. When price is going up and open interest is flushing down, you see these big bars registering on the liquidations. You're seeing somebody get squeezed who was on the wrong side of price action. And some of this unwinding has helped push us back over 40K. The question is now, will we sustain these levels? We'll be able to hold them up here. I don't know. Chances are we may range around here a bit, but I thought it was interesting to show you guys this squeezing action. Now, alongside the fall in the markets we saw on Thursday and Friday, there was also a huge jump in the expectations of tightening expressed through the federal fund rate futures on the Chicago Mercantile Exchange. So these two lines here represent two groups of expectations of the federal fund rate by the end of the year. So again, the federal fund rate is the target rate that governs interest rates. That's the lever that the Federal Reserve has when they say they're raising or lowering the target rate. Now, these two blue lines represent what the CME Fed Funds Futures traders are pricing in expectations for the end of 2022. The blue line represents the likelihood of the federal fund rate being more than 200 basis points. Right now, it's about 25 basis points. And each time they raise the rate, they raise it maybe 25. This next time, we're thinking 50 basis points, which would put it up to around 75. And this blue line is saying that basically since the end of March, traders in Fed Funds Futures have been calling for an almost 100% lock that the target rate will be 200 basis points minimum by the end of the year. Multiple rate hikes over the course of the next few months to the tune of at least 175 more basis points than we have now. Okay, you with me so far? That's the blue line. Now, the one I want to talk about is the red line. The red line is the same expectation, but for 300 basis points. And up until a week ago, the expectation of a 300 basis point or higher federal fund rate by the end of the year was only 4%. Only 4% of traders in Fed Funds Futures, 1 out of every 25, thought that 300 basis points or more was realistic by the end of the year. Well, by the end of this past week, within a 7-day period, that percentage of traders jumped from 4% to 53%. That is a crazy jump. It jumped from 4% to more than half enough to what you would consider a majority vote at this point that 300 basis points or more is now realistic by the end of the year. And what this is showing to me, when you see this in conjunction with the market's really selling off on Thursday and Friday, the last couple of days of last week, when this was rising from 4% to 53%, the market is finally surrendering to the very real likelihood that the Federal Reserve is going to continue raising rates, regardless of whether or not people think they should or they can. And as we have explored on this channel over the last couple of months, when the Fed sets out to do something, they usually stick to it until they are invalidated by the market or they achieve success. But as we deep dived in the inflation playbook video a few weeks back, their ability to catch up to inflation in this high debt environment is essentially impossible from a mathematical perspective. And at some point, I do believe that this game of chicken with continuing to tighten with record debt is going to have to end, and they will be forced to easing. But I don't know how long it will take, and I think it may play out over several more months, well into this year. One thing I'll show to help enforce the idea that they may have to revert to easing at some point. This is the Eurodollar future curve. So much like the Fed funds futures, which we explored over here, are betting on what they think the Federal Reserve's target rate is going to be at a point in time. The Eurodollar future curve is betting on the LIBOR rate, which is the London interbank rate, which is very closely aligned with the Federal Reserve rate. It serves as that version for the Eurodollar market. And when you look forward at the curve of where they think rates will be, I've noted off here quarters into the future where the rates are. And you can see they continue to raise up through June, September, December, into June of 2023, into June of next year. And then after that point, Eurodollar futures traders are starting to show an expectation of rates beginning to lower, beginning in the middle of next year. Now, this is a market of speculation. This is a market of traders. They may be very close to the pulse of the market, but these aren't policymakers and they can be wrong. This isn't the rate itself. But these people here are some of the smart money, and they're expecting that at a period of time within about a calendar year from now, maybe 15 months from now, they expect policymakers to have to revert back to a policy of easing. This is reflected here in the Eurodollar futures curve and additionally reflected in the Fed funds futures curve, which we're not going to look at today, but maybe we'll explore in another video. It has a similar trend of rates increasing through the rest of the year and then softening a few months into next year. But if events in the world continue to unfold at an accelerating rate, as they felt like they certainly have in the last couple of years, then the market may end up being wrong here. Maybe the softening comes much sooner. Maybe the reversal has to begin much earlier than anyone anticipated. I certainly think that that will be the case at some point. The Fed will revert back to a policy of easing, and it won't be because they successfully landed the plane. I believe it will be because of an obvious policy error in their mishandling of inflation. And just to kind of put a bow on what that would mean, if the Fed fund rate was raised to 300 basis points by the end of this year, just this year, it would have reversed all monetary policy essentially since the great financial crisis, because that's the last time that the target rate was that high. The target rate has not been much higher than 2.5 points in the last decade and a half. So that would be a dramatic change in a very short amount of time. So to kind of bring everything together here, I do think that we're on the beginning of a multi-month period of the Fed playing this game of chicken with rates, with trying to continue to raise them as long as the bond market is clearing the runway for them and selling off as it has been. So this is something I have my eye on, and I'll be continuing to watch over the next few months to see how this curve develops and if it continues to take this shape or maybe begins to reverse. I'm also watching expectations in the Fed funds futures market, where here they showed a dramatic increase in the amount of traders betting on a 300 basis point or higher target rate by the end of the year, which is 275 points worth of hikes between now and December. An aggressive schedule to be certain. We wait to see what the Federal Reserve does next week, May 3rd and 4th, where I expect they're likely to deliver a 50 basis point rate hike. And in the few days leading up to that point, between now and then, I'll hope for big tech earnings not to disappoint too heavily, because I believe that the markets, after experiencing this sharp drawdown to end last week, are positioned overly bearishly here at range lows, and they set themselves up to be surprised to the upside and for shorts to find themselves off sides if the market can catch even the mildest bid here over the next couple of days. And I think that no matter what happens there, Bitcoin is kind of along for the ride. The fundamentals for Bitcoin on chain, which we're not exploring today, remain stout and consistent. We haven't seen a large capitulation. We see the same kind of steady behavior that we've explored in previous videos. I'll let you know when I start to see a deviation in the signal there. So that's what I'm looking at today, friends. I really have my eye on equities and what's happening with them this week, how it's unfolding. And I want to see how the market guides itself into the FOMC next week. And depending on what happens there, we've got a CPI report coming the week after that. But I'll table that for now. We'll save that for a future video. Make sure you're following me here on Twitter at TXMCTrades. I post a lot of my thoughts and my analysis on here, and I'm very active. Great place to interact. And we'll talk again in a few days. So take care of yourselves, friends. Be kind to each other, and try not to get chopped up too much in this market action. It's very brutal out there. If you don't have an edge, you should be on the sidelines observing and waiting for a trend to be clearly established. So take care of yourselves, friends. We will chat in a few days. Cheers.